Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 224th VideoCast podcast for the week ending February 1st, 2024. First, we'll do some family updates, then we'll get right down to it. We've got a lot of Ask Me Anything questions to catch up on as well. This is Fisherman's Wharf down in San Francisco. We were out in Walnut Creek for the girls' water polo tournament, the Frozen Cup. They did great. They finished second. They won 4 out of 5 of their games, and the one they lost was pretty close. The team played absolutely incredibly. And this is Mimi in front of Lefty's store in San Francisco. She is a lefty, which is a big deal in water polo. So we thought that was an appropriate photo. This is us. I forget the name of the place, Fog something. Kind of a tourist trap, but the food's good. Baked oysters are phenomenal. And the it's like this seafood dish with red sauce. You'll know what it is. It's what they're famous for. Anyway, that's Alcatraz in the background, which we went to, which was fun to see the history of that. That's me doing channel checks at Vans, which we'll talk about in a second. That's a World War II ship in the background. That is also Fisherman's Wharf out there with Mimi and Annabelle. This is on Alcatraz Island, learning the history, etc. Pretty interesting story about the escapes and how they lived. One lived to the recent 2013, I think he was 90 years old. This is inside the Vans store in Walnut Creek. These are some of the new ones. And if you look at Google Trends for KNU, they are hockey sticking straight up for these brands. I don't know if they're in this picture. They basically, this little wavy thing is super fat and puffed out. All the young kids are buying it, which is pretty exciting to see even in the US. That's Mimi next to Waymo for our Google position, which we're perfectly happy with. And by the way, Amazon is crushing it after hours, up 7%. Pretty excited about that. More Alcatraz Island. There's a better shot from the restaurant. This is also from Alcatraz Island and Fisherman's Wharf. Oh, and that's the water polo in Walnut Creek. I think it was Northgate High School. Here's some crazy clouds in San Francisco. So we had a great time out there. There's Mimi and Annabelle at the pool. And then that's me going on walks while they're in between games and practicing. That's Diablo Mountains. Got to play 9 holes out there, and so that was fun. It was kind of cold. More of Diablo Mountains, and then I think I've got a few more. Oh, so then I went to Vans. I've never been a Vans person. I mean, I was a skateboarder when I was young. I owned a couple pairs of them. But they've got these new ones called... I don't know what they're called, Low something. Anyway, I ordered them. I think they're pretty cool. So you can see right here that it's not that wavy thing. It's a V. They're like retro. They're called Low something. Anyway, and green's my favorite color. So let me see. Hold on. I have them on now. Oh, Lowlands. So you can check those out. Pretty cool sneakers, and I'll wear them for paddle and around town and that type of stuff. All right, want to thank Phil Yin and Ryan Gallagher for having me on CGTN America last night to discuss Boeing, stock market, Fed outlook, etc., which will kill 2 birds with 1 stone because we had a bunch of Ask Me Anything questions about the Fed, and we had some about Boeing, so we're going to listen in now.
For more on these earnings from Boeing and everything else for the company, and maybe the markets if there's time, Thomas Hayes, founder, chairman, and managing member of Great Hill Capital. Good to see you again.
Great to be here, Phil. Thanks for having me.
This earnings beat, I'm not surprised because a lot of this was, this just happened, so the earnings aren't going to incorporate all of this. But the issue is the forecast going forward, right? Look, I want the company to be successful. It's in my hometown. There's nobody that wants the company to fail, but it seems like every opportunity they get to kind of rebuild trust or fix this or fix that, there's been something that's just gone amiss. What do you think's happening?
Yeah, it was years of kind of a rotten, lackluster culture, Phil, I think is the simple answer. But like Mel Brooks said in The History of the World in 1981, his film, it's good to be the king. And Boeing operates in a duopoly. And as your previous speaker said, they do have a backlog of over 5,600 commercial planes. That amounts to $520 billion in orders. And what we saw in Q4 is more of the same. They beat on the top line. They beat on the bottom line. Operating margins are improving. They generated $3 billion of free cash flow for the quarter, $4.4 billion for the year. And they deferred guidance. They did not suspend guidance. It would make zero sense for them to come out with guidance when they're still awaiting what will be a financial hit for sure from the disaster that happened on Alaska Airlines.
The CEO, Calhoun, has been under fire, and I'm sure you know his history, but I think he's an ex-GE person, basically a cost cutter, a financial manager, if you will, not an engineer, right? And that you would think Boeing would have. How would you grade management on this current crisis?
Well, the problems started before Calhoun, so Calhoun has come in kind of fixing the legacy problems, trying to make things better. He's failed at that. He took ownership of the errors in the conference call. He suspended guidance. He showed humility. He's taking all the actions. He believes the investigation is narrowing quickly and will conclude in relatively short order. That implies we'll be able to quantify the magnitude of the fine and/or penalties and/or costs to the company. And I would imagine sometime after that, they'll be able to come out with renewed guidance. But the CFO did in fact say that what they had previously guided to generating $10 billion a year of free cash flow by 2025 or 2026 was still on track. It would just be towards the latter end of the range.
And people forget that, Boeing, yes, they make commercial jets, but they also have a huge military division as well with a whole separate revenue. But overall, as a company, what would you say the health of the company financially be? And would you buy the stock right here? I think it's trading in the low 200s or so.
Yeah, we don't own Boeing, but we were looking at it today, and we do think that if we had to be a buyer or seller, we'd be a buyer of Boeing here, taking a long-term view. I can't tell you what's going to happen in the next 2 weeks or the next 2 months, but over the next 2 years, I think it's going to be much higher, and I do think it represents a value, particularly because competition is for suckers, and they don't have any. I mean, basically, it's Airbus and Boeing, and they've got huge hundreds of billions of dollars of backlog. So that's going to continue for the foreseeable future. You're seeing international travel just starting to tick up in China, which is going to be a huge source of demand moving forward. So I think it's a good play from that standpoint. And in the short term, you'll have your noise about the fines and about the problems that they're fixing from years of neglect.
I mean, you're right. If you want to invest in the aviation industry and sort of travel as a whole, Boeing is the elephant sort of in the room. I suppose you could buy hotels, you could buy other airlines. I don't know if you're looking at those industries, but how would you play it if you were interested in this particular industry?
Yeah, I think Boeing is the play. I mean, that's your safe bet. Certainly the hotels have had a move. Some of the online travel agencies like Booking and Expedia might have some value in them. But I think Boeing at these levels represents a nice value on the recovery. We had a play with Rolls-Royce, which did engine hours servicing, which was a multi-bagger off the pandemic lows. That probably has a little bit more upside over the coming years with the new CEO and cash flow generation. But I think Boeing's your safer bellwether bet.
Love it. I'm with you on it. Before we let you go, I can't have you on the show and not talk about what happened today in the stock market. We had one of the biggest drops, at least for the NASDAQ, in some time. I think a lot of people were caught, I don't want to use the word off guard, but I guess extremely optimistic of what might happen. I'm curious your reaction on what the Fed did and where you think we go from here.
Well, this is in tune with Powell's history. He stayed easy too long, and he'll stay tight too long. Nothing new there. But at the end of the day, the difference between March and May is immaterial. The economy is still humming along. You just don't want to take it much further than that because we're 300 basis points too restrictive. If you back out Fed funds rate minus core PCE or core PCE annualized, which is now under 2%, you're getting to the point that the bigger risk is now deflation versus inflation. Inflation is easy to solve. Deflation is very hard and costly to solve. So he's walking on a tightrope here. He's decided to walk a little further on the tightrope rather than declare victory and let things rip. But I understand why he wants to keep that quiver in his back pocket. However, I think if he gets too cute with it, it could be dangerous. So generally constructive. Earnings are doing fine. The economy's doing well. But Powell needs to be wary of the lagged effects and not wait too long to make things slightly less restrictive.
It's amazing how in just 6 months we went from they're not raising it enough to now we've got to do the other thing, which is cut rates. I guess we'll see what happens in the next few weeks and months. Thomas Hayes, always good to see you.
Thanks so much, Phil.
Next.
And we're back. And then I want to thank Barbara Kohlmeyer for including me in her article on MarketWatch yesterday. And we're going to spend a lot of time on this in the article of the week, which we actually have to view from our publishing on LinkedIn because the site is actually down. Bluehost, the server, is down. I don't think it's back up yet. Let me just see. No, it's not. So this is legacy from when I set it up. Pretty excited that that stayed up. Also want to thank Stephen Nellis, Arshia Singh Bajwa, and Max A. Cherney for including me in their article on Reuters. And now we're going to go through some charts just to get the lay of the land and feel for what's going on in markets. And this is something that I've been pointing to. This is from Robert Slumer over at RBC. It's very, very tough to short a breakout. Usually when you're breaking out, you get these little checkbacks, but once you're kind of going, they tend to persist for a while. So while I've been saying that, late February, early March, maybe we could get a normal 5 to 7% pullback, I think we got to bring in a lot more people in. And we're going to talk about, oddly, people are still super skeptical. And that's the wall of worry we need for this to keep climbing higher. So looking at, we closed at 4,900. So we're starting to push higher here. Maybe we'll suck in a few. I would imagine around 5,000. All the few holdout bears that have been bearish since the October 2022 lows and put people out of their stocks at the exact wrong time and have missed this 40% move, 40% plus move. Once we see those highly visible faces flip bullish, that's when we can get tactical about some short-term shorts, or we can just wait it through because the year is going to be generally good, high single digits, low double digits. So this is the S&P stuff. I found it interesting that bonds were going down materially today, as was the dollar. So that implies that the market's not buying Powell's posturing on moving out to May or June. And it's interesting, I asked a question on Twitter today, and I said, if Jay Powell knew for certain that he was going to cut in March, would his language yesterday be any different? And the answer is no. He would lie through his teeth and tell you that he's not going to cut in March. Otherwise, he would just cut on January 31st. So if he's not going to cut, his only play is to say he's not going to cut until he actually cuts. There will be no warning. When they do it, they'll actually do it and just flip like a pancake, and you'll see that stuff going. But the other thing that's really interesting here is the S&P. I guess they're using Fibonacci here versus measured move. Usually when you have these cup and handles, it's a measured move from 3,500 to 4,800, which would be 1,300, which would take you up to 6,100. Here they're just using Fibonacci extensions, so their target is 5,600. I don't think you're going to get that all this year. I think that's going to take probably into 2025. But the key is we're breaking out of this long-term consolidation. So everyone's stuck by recency bias and looking backward at all of this versus forward at what's going to be something like this. that creates our opportunity to make a ton of money as they continue to sell out and continue to be scared out by the same exact people who got them scared out at the exact wrong time right here and then again right here. That creates the opportunities for folks like us that don't worry about the short-term emotional voting machine, but focus on the long-term fundamental weighing machine and buy businesses on the basis of cash flow and future prospects versus short-term headline noise and nonsense that separate you from your money at the exact wrong times. Here's the small caps. This is basically being in a sideways range. It's lagged. He has a 24.58 target on it. I think this is going to follow suit and actually break out. So for your money, in terms of relative value, trading at 13, 14 times forward versus 20 times forward, and upside and entering an environment that is probably very similar to this 2002 to 2007 period where small caps, dollar weakened, small caps and emerging markets and China outperformed. I think this is setting the stage for a similar type of move. So those of you who missed a lot of the move that are playing catch up, I think this is where you're going to get your value. And you could say, oh my God, New York Community Bank just said the world is ending. How could you say that when the small cap indices are all small banks and energy companies? The answer to your question is the Fed's going to be cutting. Mark to market's going to go up. Commercial real estate's going to get refinanced to a greater extent than most people anticipate. And by the end of the year, everyone's working 5 days a week from the office anyway before a lot of the leases come due. And all of a sudden, the market gets reset. That's not to say there won't be some pain in the B and C properties, but I think by and large, it's going to be better than feared. Which the fear was most pronounced when we entered Vornado in the mid-teens and flipped out of it much higher. I believe that was in 32 because it's 28 now. Let's see here. I don't remember where it was, but anyway, it was out for a double, 28, whatever it was. Long story short, so we like the small caps. You can see some of these others. China, it looks like it's just retesting support here. Hang Seng, same exact thing, retesting support. All the news, which we can't show you because the website's down, but you can go visit it on the website if you get our daily reads. If you don't, go to hedgefundtips.com tomorrow, enter your email here, and you'll start to get those daily, the things that we're paying attention to each day. 10-year yield is going down again. That's good. Dollar's starting to come back down after a counter trend bounce, etc. Now, I want to show you a couple of other things. Korea exports rebounded recently, pointing to a manufacturing recovery. That's kind of a leading indicator for the U.S., and you can see coming out of recessions, this turns up first. And we have been in a manufacturing recession for 2 years, so this is a positive indicator. Rail freight carloads also sharply rebound, pointing to a manufacturing recovery. This is not the type of turnaround you see at the end of a cycle. So for all those strategists talking late cycle, ask them if they're looking at rail freight carloads, and they probably won't even know what you mean, and that's why they have the wrong framework for their outlook. So this is an important chart. Compliments of my friends over at Bank of America. You know who you are, Adam. Thank you very much. Manufacturing economy should have a sigh of relief once synchronized global monetary easing kicks in. And we're seeing that turn the corner right here, just like we did in 2009, just like we did in 2011 after the European debt crisis, right after COVID. And we're seeing right now, not late cycle end of it, beginning cycle just turning up in the right direction. Same with global wave of economic activity, quantifies trends in global economic activity, see that turning up, troughing and starting to go in the right direction. I love this last week. Hedge funds, most recent outflows, they were selling like there's nobody's tomorrow. And what are we doing this week? New highs. that tends to be the case. As you can see here on this chart, extreme bullishness and bearishness for stocks over the last almost 40 years. And we're at the low end of the range for near extreme bearishness versus bullishness for stocks. We're just kind of mid-range, no man's land. And that's a good thing. These are the kind of statistics we want to see. Canada Goose shot the lights out. China is back bigger and better than ever. Canada Goose rides on China luxury demand recovery to forecast strong quarter. So their revenues were up, largely lifted by China, was up $100 million year on year. And that offset some weakness in North America and Europe. For a total up 33 million year on year. China carried the water for this quarter, and they took their guidance up, which is huge, and made monstrous progress on slowing wholesale, lower margin sales, and increasing direct to consumer. Direct to consumer grew 14%, total revenue grew 6%. Which was big. Their revenue mix to 84% on direct to consumer. Their wholesale, they declined, which was the goal. And the revenues in Asia Pacific were up 62% year on year. China is back, and that's going to help Taobao and Tmall, not selling $1 garbage that they lose money on, selling the higher end stuff, which Alibaba is famous for. And this is very, very constructive. Now, as far as, by the way, they repurchased 3.6 million shares, which is huge. The other thing was the guidance. Yes, this was key. So they took their revenue for 2024 from 1.28 to 1.3 to 1.2 to 1.4. So they moved up the top end of the range, which was extremely constructive. And they also moved up the bottom end of the range for earnings per share. So they took guidance up, they beat expectations, they're doing all the right things, increasing margins. Everything's falling into place, and as a result, the stock was up, I think, 7 or 8% today alone. Stanley Black & Decker reports fourth quarter and full year results. So here's the bottom line. These results were great. The bottom line was the reason the stock was down a bit is because revenues were down, but free cash flow, first off, they exceeded gross margins. They're going to hit the $2 billion run rate savings by the end of 2025. Gross margins expanded in line with what we've talked about in the past. And their full year free cash flow was $853 million. And they reduced the inventory by $1.9 billion since mid-2022. Their goal was $2 billion, so they're well ahead of schedule on that. And I think what you see here is as industrials come back and the Inflation Reduction Act and all the construction, the DeWalt's, the Craftsman, the Stanleys, as rates lower, these things are going to fly once again. And we were definitely pleased with the outcome. And that was also matched by, we'll probably go into specific detail on this and do a whole article in coming weeks on this one, but generally absolutely fine. We were looking whether to top up on some companies, but our basis on some accounts, but our basis is much lower than this. So, we don't really add up. So we buy down. We don't add up. If it goes all the way back down into the low 80s, we'll have an opportunity to buy more. I doubt it. UBS was out straight away saying buy. There was a huge Q4 gross margin beat and conservative 2024 guidance. The beat came in better than expected. They guided to the low end of potential outcomes despite strong Q4 gross margin exit. And they say that we would expect, quote, we would expect a positive reaction for Stanley Black & Decker shares as the strong fourth quarter gross margin exit rate signals conservatism in the guide, meaning they're ahead of schedule on everything said they were going to do, and then they put out a conservative guide for next year, et cetera, et cetera. So we like this. Nothing's changed in the thesis. It's run a lot in the last 8 weeks. It should cool off, consolidate a little bit before making the next move higher. So we're very pleased with that. This was a guy sent in and asked me anything question, basically saying, oh goodness, he's saying, we'll do this one later. We'll do this one with the ask me anything questions. Next is, want to go through just some charts to get caught up on the markets, because we've been doing these kind of remote podcasts, which have been a little bit rushed. So let's take a look at the indices here. And you can see this is breaking out after a 2-year consolidation of no gains, just breaking out. Commercials are actually getting long into this strength, which is pretty interesting. We've just barely broken out after 2 years of nothing. And what happens after you break out? You tend to run. You break out, you tend to run. That was COVID. But even if you go back further, you break out like 2013, you run. Same thing after the great financial crisis, you run. So I think we got a couple years of running in us. Whether we get the 3 to 7% pullback in February and March, we'll see. Everyone's looking for it, which is usually when you don't get it. But I do think we are kind of due, but not yet. I think we got to flip all those last bears, and they won't flip because they're like they believe the story. They will flip because they've been so wrong for so long that unless they flip, they're going to lose their jobs and their careers forever. It's embarrassing how wrong they've been. So, so once they flip is where we intend to get a little bit tactical, maybe put some hedges on or some shorts, or maybe sell some calls against things that have run a lot. Oh my goodness, Amazon is up 9% after hours. This is pretty exciting. It probably won't be in the morning, but Russell, I think this is your catch-up trade. I think this is where a lot of money is going to be made. I think New York Community Bank, they were also involved in that crypto nonsense. So while they're blaming it on commercial real estate, I don't know. I'm not seeing it show up in the money center banks unless they were just a terrible underwriter. I'd be skeptical of that. I think that's more of a one-off than anything else. And let's take a look at energy, because we've got Comstock for natural gas. WTI is trying to turn up a little bit. But natural gas, I like this. This reminds me a lot of 2001 to 2003 period. You get that abrupt move up in the recovery, then a crash, and then you move straight up for 5 years. I think we're going to be in a similar situation based on supply, demand, and everything else, and how much everyone hates it, which is why I love Comstock Resources and have been using that opportunity to build and build and build. So we're excited about that. Bonds, I really didn't think I was going to get another opportunity. And by the way, that and our basis is still below where we're buying. We very rarely buy up, but this one came in enough that it made sense. And when you consider the liquidation value at 3x of current where it's currently trading, and then you add the unproved reserves, and you're looking at, $40, $50 stock. So, from 7, that's pretty exciting if you take a 3 to 5 year view. It could be another range resources for us. So let's take a look at bonds here. You have this counter trend bounce that seems to now be winding down. And as excuse me, let me rephrase that. This was the counter trend bounce in yields, and now we're resuming the uptrend in bonds, which we've been talking about since September and August of last year, when we said hedge funds were the most short bonds than they've been since the 2018 lows, and you got a monster rally. Well, they're the most short ever, so this is going to keep persisting up higher, and commercials are buying it. That's the smart money in green. So bonds up, yields down. That's going to help a lot of our positions, cyclical positions, small caps, emerging markets, biotech, everything we discussed in the article with Barbara Kohlmeier, which we're going to discuss. Some of the softs are getting bid, so just keeping an eye on that. from an inflation standpoint. The metals have basically been sideways. Meats, you do have a cattle shortage. And grains have been in the gutter. People are starting to get bullish on grains. We'll see. Looks a little early to me, but I'd be more of a buyer than a seller, taking a longer term view. And currencies, you had this little counter trend bounce, which appears to be over for the US dollar. Weakness in euro, I think euro persists higher. Pound, all the currencies against, and the one that I love the most, honestly, I'd love to get aggressively long the Japanese yen, particularly relative to the US dollar. I think that's going to be a monster trade. That's not what we do, but pay attention to that one. But I think dollar weak and all these other currencies are going to start to catch up, and we've talked about that. So let's go to the article of the week, which is "It's Good to Be King, Stock Market and Sentiment Results." On Wednesday, you heard Phil Yin, where I talked about why it's good to be the king as it relates to Boeing, and competition is for suckers as it relates to they have no competition other than Airbus. So there are notes. On Tuesday, I was tentatively scheduled to be on Fox Business. It was pushed back to a later date. But here were my prepared show notes and 2 stock picks, position we owned from lower levels. So on the general market, I said, yes, we're a little bit overbought. Yes, we're a little bit exuberant. Yes, we're a little due for a pullback. But one big problem, we haven't brought in the last of the adamant bears who have been pounding the table short for the full 40% rally off the October 2022 lows. Once we flip the final holdouts, probably another few percent upside in the indices. We can expect a healthy pullback of 5 to 7% in late February, early March. Hard to get too aggressive or short or apocalyptic when we're just breaking out to new highs following 2 years of 0% returns and sideways consolidation. So you can see it here and here. And now with big tech blowing the doors off, although I can't see Apple yet, but with big tech largely blowing the doors off, that's going to take earnings up, which is going to surprise a lot of people. That's the general election pattern from FundStrat, which we've covered many times since late last year and early this year. So Fed next step, which we covered, 2 possible doubles from lots of COVID troubles. See that? I can rhyme. Advanced auto parts, still 70% off the all-time highs. That's moved up a lot in the last few months. I was talking about this in the context of going on Charles Payne's show. When I talked about it on Payne, it was at $59. Now I think it's 77 or 78. I'm sorry, 67 or 68, 13, 14, 15%. Sales were up last quarter, 2.9%. Comp store sales up 1.2. Free cash flow, 148 million. Cash balances grew, paid down their revolver. The new CEO, Shane Kelly of Home Depot Supply, $7 billion business, is delivering on his plan to sell the Canadian operations, cut 150 million of cost, and build U.S. pure play blended box for do-it-yourselfers and professionals. People at the low end hanging on to their cars a lot longer as OEMs catering to the high end. New cars with an average sticker of 48,000. The low end needs parts to keep the 13-year-old cars running. Can be a double plus from these levels over the next 24 to 36 months. Stanley Black & Decker, same story. Up single digits since we were on his show. $2 billion of run rate savings by 2025. They're ahead of schedule. I think they're actually well ahead of schedule now. They just reported today. They want to grow organic revenue at 2 to 3 times the market through innovation with DeWalt, Stanley, Craftsman, etc. They're on track doing that. They generated $360 million of free cash flow last quarter. That's actually, we got to update that obviously from last night, but free cash flow, whatever it was, 860 for the year. And I think they're guiding somewhere in that range, 700-800 for next year with their conservative guide. And they've taken down their inventories now, not 1.7 billion, but 1.9 billion. So everything they said they're going to do, they're doing. And that's why the stock is starting to recover. Markets and the Fed, after being bullish since October 2022 and October 2023, when many strategists were scaring people out of their stocks at the exact wrong time. In last week's podcast, VideoCast, and note, I indicated that with sentiment at heightened levels, it would be, quote, trickier in the short term. This does not change our 2024 outlook, which Barbara Kohlmeier was so kind to feature in MarketWatch yesterday. Click on the images to go to the original MarketWatch article. And the headline of the article was, "This money manager nailed 2 big stock market turning points. These are his next rocket ship ideas." I'm very grateful for that, because when you put yourself out on a limb, and most people are unwilling to do that, when 99% of consensus is against you, it takes a lot of courage and you take a lot of heat. Sometimes it's for days or weeks, etc., or months. But when you know your framework, it works out sooner or later. And it's nice for people to remember that, is really what it comes down to, because it's not easy, and very few people do it. So a couple of the things here is our call of the day comes from Tom Hayes, founder and chairman, long-short equity manager, Great Hill Capital, who made some prescient stock market calls in that period and has some rocket ship investing ideas to share. After calling the pandemic bottom, and if you click on that link in the article, it will take you to the March 19th, 2020 article on MarketWatch, where we literally did call the bottom. I didn't know it was going to be the next day, but I'm very, very grateful for her recognizing that, because that was not an easy call in the middle of chaos. And the premise was, I basically overlaid this 1917 to 1980 Spanish flu, and the Dow only fell 33%, and we were already down 32%. I said, we're buyers, we're stepping in here. Yeah, we can't predict the future, but a lot of bad news is priced in, and that proved to be the case. Hayes was among a handful of investors who turned bullish on stocks in October 2022 and October 2023, both big market turning points. For example, in October 2022, we took long positions in Amazon and Alphabet when, quote, you couldn't give them away, and says they have no plans to sell. Well, fortunately, we did not sell. Amazon's looking good. Speaking to MarketWatch on Tuesday, Hayes admitted to his less lucrative bets, biotechs and Alibaba, tied to expectations for a faster recovery in China, but sees a turnabout coming. Quote, now the Fed is getting out of the way. I think it's a rocket ship both in Alibaba and biotech. We already started to see it in biotech, by the way. It's off the mat from 70 to 90 in the last couple of months. We think that can go up to 140 on the XBI, and now, or more. Hayes, who blogs at Hedge Fund Tips, again, very sweet of her to link to the website, explains that because it was the #1 article for like the first 6 hours of the day yesterday, which is huge. Their website gets a huge amount of global traffic. Explains that there's money to be made in our long, maybe that's what crashed the website, who knows, in long duration assets. Quote, so those assets that were negatively impacted by high rates are going to start to outperform as we move into the great normalization period, he said. Biotech and real estate investment trusts are areas to look at. As for the former, Hayes says this year will be about deals and drugs. So as capital becomes more available, as the Fed becomes more accommodative and risk appetite increases, you're going to see these start to produce. Big Pharma has lots of cash, but little growth and innovation, and will need deals with undervalued biotech companies to make that happen, he adds. Smaller companies are lagging a bit as they have, quote, not started to behave in line with rate normalization environment. And with that, I'm talking about regional banks, which will probably take a couple of weeks of choppiness because people are scared about this one-off New York Community Bank, and then they'll resume their uptrend. You've seen what's happened with Citi. It's been a rocket ship in the last few weeks. There's still pent-up demand because there was limited supply due to the what is he like in the small caps? He owns Cooper Standard, a global supplier of sealing and fluid transfer systems and components for GM, Ford, Stellantis. Shares have climbed to $18 from $6 when he first started buying. Well, yes, but our initial basis was $5.10. We bought some at $6, and we bought some below at $4s. And that basis was $5.10, and then we've got a new tranche from new clients that have come in, some in the 12, some in the 16th 16s, and it's still cheap. There's still pent-up demand because there was a limited supply due to the semiconductor shortage just a year and a half ago and before. As those volumes return closer to pre-pandemic, the operating leverage in some of these auto parts suppliers to the companies producing new cars will be phenomenal. We're seeing it already. He also likes Canada Goose. How lucky can you get? She published the article yesterday, and today Canada Goose knocks it out of the park, and the stock's up 8.5%. The Apple Store of luxury expensive jackets, as it's increasing margins and direct-to-consumer sales and poised for a good turnaround recovery story looking out 24 to 36 months. Hayes owns Comstock Resources, another small cap which sits in the most hated sector of natural gas. He sees it as a turnaround play on global demand, even though it's currently a depressed asset. As for the year ahead, he sees the general indices rising by high single digits to low double digits, which would be in line with an average presidential election year, average 11.28 since 1928. So the bigger opportunities are going to be under the surface. And I think the alpha opportunities are going to be found in small and mid caps and emerging markets plus China. So very, very grateful for that. So despite Chair Powell waffling yesterday and implying March cuts were no longer a foregone conclusion, the Fed Fund futures were still pricing in a 53% chance of a first cut coming in March as of 9 p.m. last night. That went down to 35% today, but bonds aren't buying it. 10-year yield was down to 386. And this ticked up a little bit as the day went on to 37.5. That's pretty high for someone saying not our base case. And again, I ask you this. If Powell knew for certain he was going to cut in March, how would his language have differed yesterday? And the answer is it wouldn't. He would have still lied through his teeth if he wasn't ready to cut yesterday, because that's the only tool that they have is forward guidance. And how do you keep a lid on the market and easing conditions before you get the inflation and jobs data you're looking for? You lie and you say you're going to keep things restrictive, but the market is not buying the story. So here's what Fed whisperer Nick Timiraos had to say about the FOMC statement and press conference. So a couple things, he recapped what he said, but there were a couple things I starred. It could cut rates sooner and faster if the labor market weakened or there was a very, very persuasive lower inflation. Well, I don't know how much more persuasive you need than 1.6% and 1.9% annualized on core PCE from the 3 and 6 month data. But leaving that aside, Timiraos pointed out the 6 months annualized inflation rate fell below 1.9% during the second half of the year, down from 4% in the first half. The other thing is they could lower rates even with solid growth. That is because as inflation declines, inflation adjusted or real rates will rise if nominal rates are held steady. This is an important concept. They get more and more restrictive by not moving, and that could precipitate deflation if they're not careful. The current stance of policy is no longer warranted by the inflation backdrop. The prudent policy stance is to return to a neutral setting, said Dalip Singh, former executive at the New York Fed, who is now chief global economist at PGIM Fixed Income. And finally, that quote, there are potentially serious costs and little benefit to waiting. The longer they wait, the larger the risk will grow. And that's what we've been saying. Deflation is a much harder problem to solve than inflation. They don't want to dither too long. Google, everyone was down on it. We just drew this out. Here was the fall of 2022, which Barbara referenced in her article, when you couldn't give them away 65% later. Actually, it was more than that, but it came back. And we said, is it going to hold this breakout? It looks like it is based on what happened today, so we'll see. This shook a lot of people out of their stock, I'm sure. And as Barbara referenced, we bought Google and Amazon in the fall of 2020 when you couldn't give them away. and many of you on the podcast did as well. They both had monster gains, and we have no intention of selling them in the near term. So you see Google earnings. People got sideways on this because some of the costs were a little bit too high. But it's Google. They'll figure it out, and they're buying back a ton of stock in the meantime. Share count's coming down. Revenues are going up. The middle stuff they can take care of, and they just did with an announcement of a huge layoff. Cash balance is going up, generating free cash, doing all the things we need to see them do. All of that is a positive thing. Final thoughts. Last week in the podcast, we discussed a likely 5 to 7% pullback in late February, early March timeframe. Could it be early? Remember, I write this on Wednesday nights. I said possibly when the market was down and futures were down, but I wouldn't count on it. I think we will see some more breadth improvement before a short-term top. In the scheme of things, does it matter? It does not matter, as the year should end up nicely, high single digits to low double digits on the indices, but we wouldn't mind a few more percentage points up first in order to sell some calls against our longs or possibly put on some asymmetric tactical shorts if the opportunity presents itself. At these levels, it makes more sense to wait it out. If we push higher and finally flip the last few vocal bears who have been bearish since the October 2022 lows, and missed a 40% plus rally since, it will make some more sense to make tactical moves. Time will tell, but my experience indicates that, quote, the first move after a Fed meeting is often the wrong move, end quote. And so far, the first move is down. We'll see how it plays out in coming days. I drew this trend line today. It held the trend line. We'll see if that follows through. Sentiment was high for retail investors. Started to get more neutral for the fear and greed, and the equity exposure for National Association of Active Investment Managers is, let's see what that went to today, 87. So it's high-ish, but that happens when people are chasing. Moving right along, financials, top 30 weights estimates revised up 0.74% in the last 60 days. Healthcare top 30 weights were revised down by 2.33% in the last 60 days. And then if you look across earnings, which we've covered quite a bit this week, we can just point out a couple here. Let's see here. Helmerich Payne is a oil services company. They beat on the top and bottom line. That's interesting to see. Microsoft, obviously, top and bottom line. Alphabet beat on the top and bottom line expectations. Danaher is a major one. Pfizer beat. Stryker. UPS missed on the top line. So much for the unions. They got their increase in pay, and they just laid off 12,000 workers. And the auto workers will be next. Congratulations on your raise. You're fired. Starbucks missed. They've got a lot of competition from Luckin in China that they're not really acknowledging. Mondelez, even the Oreo company beat on the top and bottom line. I thought everyone was taking GLPs and no one would ever eat an Oreo again. I guess that wasn't true. Chubb beat on the top and bottom line. Diageo, no one's ever going to drink alcohol again. So more and more of these are beating. MasterCard, that gives you the pulse, which should be positive for PayPal this quarter. Qualcomm beat on the top and bottom line on positive handset. Boeing we covered in the segment with Phil. And I think that's it for right now. So, AWS segment, by the way, the cloud was up 13% year on year. And, all right, this is an important data point that came out today on continuing jobless claims were higher than expected and initial jobless claims were higher than expected. This type of softness, if it is confirmed by the non-farm payrolls report, the jobs report tomorrow, would be a governor on the Fed, meaning they'd have to curb their enthusiasm about being higher for longer if this plays out on the non-farm payrolls. The most important thing about the non-farm payrolls is not the headline number, it's all the revisions. And 10 out of the last 11 months have been revised down to the cumulative effect of 500,000 jobs were over-reported in the last year, over 500,000. So I think, yeah, there'll be some headline, maybe that will be goosed. But look at the revisions from last month. My guess is they'll be revised down by 50,000 jobs, just like they have been pretty much every single month, which tells you everything you need to know about the Fed, what the Fed needs to do by March, which is taper the taper and do their first cut. Okay, next. Ask Me Anything questions. So the podcast is officially over. We're now going to start the Ask Me Anything questions for a lot of catch up here. John Lee is asking about Warner Brothers Discovery. We've discussed that already. I wanted to get your thoughts on Geo Group, dominant play. I think Warner Brothers Discovery works for a trade, but it's not the type of business I want to own. So, I think that'll work for you, but not for me. Wanted to get your thoughts on Geo Group, dominant player in the private prison space. We've covered this in the past. I think it's a low quality business, but it's kind of a duopoly. So yeah, it's $12. It probably works its way up to 20. I think, let me see if I have this here. Okay, so for Geo, this is a low return on capital business. By the way, I'm going to do this one from memory. I think it works as a trade, but I wouldn't give it much more credit than that. And I know it's one of Michael Burry's only long positions because he's been bearish on the market for the last 12 years. But when he does pick a long, you do have to pay attention because he's a super smart guy. And this one is probably one of them. But again, it's a low quality business and there are better uses of capital in my view. So thank you, John. Brian McLean, longtime listener, 1.5 years or so. I couldn't agree with your investment philosophy more. I tell as many people as I can about your podcast because I think the work you do is invaluable. And although your insights might be against the grain at times, I'm always eager to hear what you have to say and typically agree 100%. So thank you for that. What are your thoughts on Carrefour? So I looked at this before, and I'm not sure why this thing is freezing up. But what I could say about Carrefour is it's passed for us because if you look across the earnings and revenues, etc., what you're going to find is that they have not grown in years. And it's got a low return on capital. Let me try to do this brand new. And they're just better uses of capital. So we're going to take a pass on that and move on to the next one. Brian says, P.S. one day I'll be your client. I need to bulk up on the old savings cash flow first. Well, thank you. We'll be here. I appreciate that. And I appreciate you sharing it. And by the way, if you're getting value from these podcasts over the years, and making money and you can't afford to be a client, the best thing you could do to repay the favor is to share it with one or two people you know who really like markets and could benefit. The faster we grow, the longer we're going to do it for non-clients, and I appreciate your help on that. Justin from Montana, I know you have auto suppliers covered with the position in Cooper Standard. Thank you very much for that. What do you think about Visteon? Visteon's already run a lot, so it's a good business, but I've missed it. There's not enough juice there. Next is Alex asks, your VideoCast is a perfect example of how price and value can be quite disconnected, so thank you very much. Although I lack previous exposure to commodities, your recent reference to Comstock Resources inspired me. So he does this whole analysis on PV10, and it's the wrong way to think about it because, number one, you can't predict natural gas prices, and number two, what you haven't accounted for is the 15 years of unproved reserves, which still have value, and that puts it for me around $40 worth of value over time. I focus on the things I can control, which is my analysis, the balance sheet stability, so as to be able to wait, and low leverage so that I don't get shaken out of the position before I have a 7 or 8 bagger. So In this one, it would be probably more like a 6-bagger, but 5 to 6-bagger, and I think it'll be quicker than 8 years like it took, 6 years like it took Range Resources to be a monster multi-bagger for us. So yeah, and the other thing you got to keep in mind is sometimes you got to use a crayon versus a scalpel. You're not going to get it exactly to the penny, but what you have to understand is if you're buying with a large enough margin of safety that even if you're wrong, you come out with a huge profit, or if you're super wrong, you come out flat. And that's what we always look for. The two questions, we have two filters. Number one is if this position, because there's always things you don't know that you don't know. So if this one position went to 0, would they carry me out on a stretcher, or would the rest of the positions more than adequately compensate and be able to compound capital at above average rates of return, even if this one went to 0? So in other words, they would not carry you out on a stretcher. And if the answer is yes, then you proceed. And the second question, will it carry me out on a stretcher? The answer has to be no. And the second question is, if I walked into the board of directors meeting and offered to take their company private, 100% of their company private, financed by whomever, if JP Morgan financed me, at the current market price, would they have to have me escorted out of the building? And I like and usually need the answer to be yes. In other words, I need the price in the public markets to be so ridiculous that if I called the market's bluff and actually offered to take the entire company private at that price, they would have me removed from the premises because the board knows the company is worth at least 50% more, at least 100% more, at least 200% more, at least 300% more. So that's that. If I offered to take Alibaba private at $75 a share, they'd probably have me arrested and put in some type of camp over there because it would be such an insult. But that's where it is right now in the public markets, and that's the opportunity it's created for us to gobble it all up. Devin Daringer, hey Tom, what do you think about elections in the U.S. this year and China stocks? People seem very worried with Trump. I could care less. And by the way, go look at Chinese performance under Trump. Chinese stocks rocketed under the Trump administration. So with all the, that's why politics is such a loser's game for investors. Everyone thought Biden got elected and energy stocks would crash. The exact opposite went up. They had 2 monster years. Everyone thought Trump got elected, energy stocks would fly. They absolutely crashed. Everyone thought China would beat up, Trump would beat up on China. Instead, their stocks had one of the biggest runs. 2016 to 2018, look at Alibaba. It went to $320 under Trump with all of his trade saber rattling. And then under Biden, who was supposed to be weak on China, they all collapsed. So that's a bunch of noise. Stay away from politics when it relates to investing. Philip Andrew asks, following your insights, anticipate upswing in China equity multiples, and your strategic plan to rotate profits from China to India for capital compounding over the next decade. I'm eager to learn more about your specific investment themes considering with Indian equities markets, aside from tradition. I have no themes in Indian equity markets because we're nowhere near the time it's time to focus on Indian equity markets. That's recency bias because they've had a run the last few years. I think demographically speaking, it's 5 years out after we're getting out of China. Daniel D, at what pullback level would you add to biotech? I don't add up. We bought a ton lower and we're going to hold it for a long time. Bob Smith, Cooper Standard reports cost savings to save $500 million. If via production returns to COVID levels, would you still expect $7 a share, or would you expect a higher amount? Yeah, I don't know. It could be $5. It could be $9. The point is that their interest costs have gone up. Their run rate has gone down, so it's probably a wash on that front. And I'm kind of modeling for 85% of 2017 production, and that's how I get to 5 to 7. And then the question is whether it's a 10 or 20 times multiple. But the key is I've got a large enough margin of safety that I don't worry about those type of things for the exact exit. I don't buy it all on the same day, and I don't sell it all on the same day. I'll sell some on the way up, and I'll sell some probably over $100, which would be pretty exciting. So JT said, would you please share your thoughts on Boeing? I did that with the Phil interview. JP says, hi, Tom. I listen every week since early 2021. Thank you very much. I know a lot of you loyal listeners out there. I'm very grateful for you. Currently invested in Cooper. Could you add some color on the filing that BlackRock just acquired an 8% stake? Thought they had a poison pill. It's not a poison pill. They have to approve it, and JP Morgan's a passive investor. So it's just showing more and more institutional sponsorship coming back as they've been consistently above $10 a share. Most institutions can't own anything below $10 a share. Sam R., any specific book you recommend in terms of understanding the structure of hedge funds and terminologies? The best thing you can do if you want an investing career is read all the CFA books. But if you want to learn about hedge funds in particular, I thought the book by Sebastian Mallaby, More Money Than God, was a pretty good book. Kayla Smith, always great watching you. 2 AMA questions. Neat seeing the water polo updates. Did you swim or play water polo in your youth? I was a swimmer. Freestyle was my best. They're both major swimmers and water polo players. The eldest is more serious on the water polo. The youngest is more serious on the swimming. I did not. I was a very competitive hockey player, played up to junior B, and then was supposed to go to Hamilton to play and wound up getting into Columbia, and they just had clubs. So I played for a half a semester, a half a year, and it was not competitive. And I said, all right, on to the next. Caitlin played D1 soccer. What are your thoughts for Archer Daniels Midland? Had a huge plan after the CEO's investigations were being accounts were being investigated. Worst case scenario of accounting problems reminds me of Enron WorldCom and their accounting standards. I don't think it's going to be that bad. As a matter of fact, I've been looking at potentially buying this. I'm not there because I generally don't like to buy on the accounting weaknesses because it could be a big problem. But I'm keeping an eye on that one because this is a reasonably good quality business over time that's temporarily impaired, but I'm not there yet. And Kayla, you have brought some very good questions on companies over the last year, and most of them have been winners. So I like that you're sniffing around this one as well. Bob Johnson, could you take a look at Costco? Yeah, Costco's great, but I mean, it's like a utility at this point. So go for it. It's not going to double over the next 12 months, so I'm not interested. Philip Pinkos said, given Biden-Harris administration's decision to halt LNG permits, how does it affect your thesis on Comstock? It doesn't. It's a bunch of noise because at the end of the day, there's global demand and there's global supply. And sooner or later, the politicians bend as the prices get too high when they control supply. So I'm not worried about that. What I care about is their proved and unproved reserves and how much I'm paying for those, because sooner or later, the demand will get sucked out of the ground and we'll make money and free cash flow. And we think we're going to make a lot more than what we're paying for the stock. Daniel, Tom, what's the pain trade for the 4 main indices, up or down? It's in the middle right now. I'd say it's skewed toward down, but it's not quite there yet is my best estimation. And we're not really at a super extreme that I would like to see before I started getting a little bit more nervous. Dante Nesperoli, like to hear you refute some commentary from a very large and respected Canadian bank, National Bank of Canada. Large and respected Canadian bank, that's kind of an oxymoron, but we'll go with it. All right, I'm joking. I read all that. Go look at the indicators. Every single one of those indicators that they're pointing to for a recession is actually turning up. So I'm not sure what they're looking at, but if you look at it with a critical eye, you're going to see that they're mostly in the conditions you would like to see in a recovery, not in a recession. Mohammed, and that's consistent with what I've been saying for 2 years, which is we had the recession in the first 2 quarters of 2022 when we had 2 consecutive negative quarters of GDP. Mohammed Atabi, thoughts on the FOMC? I covered that with Phil. And Ite asked me to look at LEAT. I can't do that right now because the computer's frozen for some reason, but I will get to that one next week. I want to thank everyone for tuning in this week. We'll be back next week, same time, same place. In the meantime, make it a great one. Bye for now.